Well, the markets have been a little interesting this year, haven't they?
Yeah, a little rocky for sure.
I mean, just stepping back and looking at it, the major indexes are down something like 10%, give or take, from where they were at their peak.
Yeah.
And that can be a little unnerving for folks.
Oh, yeah.
But, one of the things that I think starts to look a lot more appealing when you see stock prices cool off a bit like this is companies that pay dividends.
Oh, absolutely, yeah.
When a company's paying out, a certain amount per share
Right.
as a dividend, that yield, the percentage of the stock price,
Yeah.
it just naturally looks a lot more attractive when the price comes down.
Well, if you think about it, I mean, if you're looking for a stream of income from your investments, this kind of market that we're in right now,
Yeah.
it's actually, I think, opened up some really compelling opportunities.
Yeah, I think you're right.
Yeah.
And then that's actually what kind of led us to this article from The Motley Fool. They published it just yesterday, March 15th, 2025.
Fresh off the press.
Yeah. And they highlighted 5 specific companies.
Right.
And these aren't just companies that are paying nice dividend yields. I mean, we're talking over 5% here.
Nice.
But they also have these really strong track records of increasing those payouts year after year
Consistently.
to their shareholders. So, the idea here is the potential for, a really nice stream of income.
Yeah.
That isn't just a fixed amount, but something that could actually grow.
Yeah, grow over time.
Over time, yeah. So let's just jump right into these companies, huh?
Yeah, let's do it.
The first one that they had on their list was Brookfield Renewable.
Okay.
And they trade under the ticker symbols BEPC and BEP.
Got it.
And right now, the current dividend yield is sitting at around 5.2%.
Okay.
Now, renewable energy, clearly a sector with a lot of momentum these days.
Lots of tall winds.
How are they generating the kind of consistent cash flow
that it takes to support a yield like that?
Yeah. So what's really interesting about Brookfield Renewable is the way their business is structured.
Okay.
It's actually very stable, a lot like a traditional utility company.
Okay.
So they sell the clean energy they produce to other utilities and large corporations through these long-term contracts.
Uh-huh.
And that right there, that gives them a really predictable and reliable stream of cash coming in.
I see. So it's contracted.
Yeah, very contracted.
Okay.
And here's a key detail. A lot of these contracts actually have clauses in them that link the price they charge to inflation.
Wow. Okay.
So as the cost of living goes up, their revenue is sort of built in to increase right along with it.
That's smart. All right.
It is. So they're focused on these long-term power purchase agreements with really creditworthy counterparties.
Mm-hmm.
It really gives them a bedrock of predictable revenue. And that helps insulate them a bit from the short-term ups and downs in energy prices.
So, that kind of volatility.
So it's not just a good yield today.
Yeah.
But the potential for that yield to sort of grow organically with inflation, that's pretty cool.
Yeah, that's a great point.
What about their plans for, expanding their business?
Okay, sure.
And further boosting that dividend growth?
Well, Brookfield Renewable isn't just sitting around, collecting checks on their existing contracts.
Right.
They had a big pipeline
of
new development projects in the works, building out new renewable energy facilities. And they're also really actively pursuing acquisitions of other renewable energy assets, things that fit into their portfolio. And because of all that activity, they're actually forecasting some pretty significant growth in their cash flow per share. They're aiming for over 10% annual growth.
Wow.
Over the next decade.
Okay.
And it's that strong expectation for growth in their earnings. That really supports their stated plan to increase their dividend payments by 5% to 9% each year.
That kind of dividend growth on top of a 5% yield that's pretty eye-catching.
Yeah, it's significant for sure.
And they've been consistently growing that dividend for a while now, right?
As of this year, Brookfield Renewable has delivered at least 5% dividend growth for 14 straight years.
Wow.
So that kind of consistent track record is really what dividend investors look for.
Yeah.
It suggests a real commitment from the company to returning value to its shareholders.
All right, let's move on to the second company on the list here.
Okay.
Enbridge, trading under the ticker ENB.
Right.
And they're in a different part of the energy sector, primarily pipelines and utilities.
Right.
And their current yield's sitting at around 6.3%, according to the Motley Fool.
That's right.
So very different business from Brookfield Renewable.
Yeah, it is. Enbridge is a Canadian company.
Oh.
And what I think is really remarkable about their financials is just how stable they are.
Okay.
They say that something like 98% of their earnings come from assets that are operating under either what are called cost of service agreements, which are essentially contracts where their rates are regulated. That provides a very predictable income stream.
Right.
Or other types of long-term contracts.
Okay.
So this very high percentage of stable contracted revenue makes their earnings super predictable.
98%. That is a seriously high level of stability.
It is. It is.
It sounds like there's just not a lot of volatility in their revenue.
Yeah. And in fact, they've managed to achieve their financial guidance, those targets they set for their financial performance for the past 19 years in a row.
Wow.
So that kind of consistency over nearly 2 decades, it really speaks to the reliability of their underlying cash flow generation.
And even with a dividend yield as high as 6.3%, their payout ratio, the percentage of their earnings that they're paying out as dividends, is still in a pretty comfortable range.
Yeah, 60% to 70% of their stable cash flow.
Okay.
So that leaves them a good chunk of capital to reinvest back into the business.
And they are investing in growth, right?
They are.
The article mentioned pretty significant backlog of expansion projects.
They do. They've got this multi-billion-dollar backlog of capital projects that are expected to come online and start generating revenue between now and the end of 2029.
Okay.
The article specifically called it out as, providing highly visible growth for the company in the coming years.
Yeah.
Meaning, they have a clear line of sight
yeah.
to future earnings increases from these projects.
Okay.
And because of this anticipated growth, their management team expects to grow their cash flow per share by about 3% per year through 2026.
Okay.
And then they're anticipating that growth rate will actually accelerate to around 5% annually after that.
So pretty good growth.
Yeah. And, that projected growth in cash flow should translate into continued increases in their dividend payments to shareholders.
That's what we like to see.
Exactly. Enbridge has a really strong track record of rewarding its shareholders.
Right.
They've increased their dividend for 30 straight years as of 2025.
That's amazing.
It is. And their guidance suggests that those dividend increases will continue in that same annual range of 3% to 5% going forward.
30 years of consecutive dividend increases.
Yeah.
That is the kind of history that I think can give investors a lot of confidence.
Oh, absolutely.
In a company's commitment to its shareholders.
Yeah, definitely.
Okay, let's move on to the third company. NNN REIT.
All right.
Ticker symbol NNN.
NNN?
Currently yielding around 5.5%.
Okay.
Now, REITs, real estate investment trusts.
Right.
These are all about owning and operating real estate, right?
That's right. And NNN REIT focuses specifically on single-tenant retail properties. So, think about the buildings that house individual stores or restaurants.
Right. Got it.
And the key to their stable cash flow, which allows them to pay that nice dividend, lies in their use of long-term net lease agreements.
Okay.
The average remaining term on their current portfolio of leases is about 10 years.
Okay.
Which provides a lot of predictability and visibility into their rental income for the next decade.
So they've got long-term contracts.
Long-term contracts.
Got it.
Locked in.
And with a net lease, the tenant's actually responsible for a lot of the property-related expenses, right?
Exactly. Under a net lease.
Okay.
The tenants are actually contractually obligated to cover all those major operating costs associated with the property.
Got it.
Things like property maintenance, building insurance, and real estate taxes.
Okay, that makes sense.
So this structure really reduces the volatility of NNN REIT's expenses, which makes their cash flow even more stable and predictable because they're not on the hook for any unexpected increases in those costs.
Okay, so they've got a pretty reliable stream of income coming in.
Yeah.
They're not as exposed to fluctuations in operating costs.
Right.
How do they plan to continue growing the business and maintaining that dividend payout?
Well, they've got a pretty conservative approach when it comes to their dividend payout, meaning they don't distribute all of their available cash flow as dividends.
Okay.
This allows them to retain a good portion of their earnings, and they use this retained cash to invest in acquiring additional income-generating retail properties that fit their investment criteria.
So very disciplined in their approach.
Very disciplined. It's a steady strategy of gradually expanding their portfolio of properties.
Okay.
And that helps them to consistently increase their overall revenue and, in turn, grow that dividend over time.
And their track record in doing so is pretty impressive.
It is.
The article mentions that they have the third longest streak of dividend increases.
Wow.
In the entire REIT sector.
That's a tough sector to do that in.
Yeah, how many years are we talking about here?
35 straight years.
35 years of dividend increases. That's a really strong testament to their business model and their financial management.
It is. It speaks volumes about their commitment to returning value to shareholders.
Okay, let's move on to the fourth company on the list.
Okay.
Rowe Price Group.
All right.
Ticker symbol TROW. Also yielding around 5.5%.
Okay.
And they're in the asset management business.
Right.
So their revenue must be pretty closely tied to the performance of the markets.
It is.
And how much money they're managing.
It is. You're right on the money there.
Okay.
Their main source of income is those advisory fees that they charge their clients.
Right.
And those fees are directly linked to the total value of the assets they manage, often referred to as AUM.
AUM.
Assets under management.
Yeah.
So as the value of the investments they manage goes up,
right,
and as they attract new client assets, their revenue naturally tends to grow.
Okay.
Last year, their AUM hit a pretty substantial $1.6 trillion.
Okay.
Which was actually a really healthy 11.2% increase.
Wow.
Compared to the year before.
Okay.
So that growth in the amount of money they were managing directly contributed to higher fee revenue.
Yeah, so their performance is definitely linked to the broader market.
Yes.
And their ability to attract and retain clients and their investments.
For sure.
What are some of the key drivers that they're relying on for continued growth in their business?
Well, they're strategically focusing on a few key areas to drive that future growth. One big one is the expansion of their offerings in exchange-traded funds.
Okay.
Or ETFs.
ETFs? All right.
They now have a portfolio of 17 different ETFs.
Wow.
With almost $8 billion in total assets.
Okay.
They're also really actively developing innovative retirement product offerings.
Right.
To cater to, a wide range of investors. They're expanding their options in alternative investments.
Okay.
And they're also seeing growth in their insurance platform.
So really diversifying their business.
Yeah, all these different initiatives are aimed at attracting and retaining more assets under management.
Right.
Which, as we talked about, is really the primary engine for their revenue growth.
Right, and that revenue growth in turn has historically translated into consistent dividend increases.
It has.
For their shareholders.
Absolutely. Earlier this year, Rowe Price announced their 39th consecutive annual increase in its dividend payout.
39 years.
It's pretty impressive.
That puts them in a very select group of companies.
Yeah, for sure.
39 years, that's an incredibly long and consistent track record.
It is, especially in a field like finance, which can be pretty turbulent.
Yeah, no kidding.
It's no small feat.
Okay, last but not least, we have Verizon Communications.
All right, Verizon.
Ticker symbol VZ.
VZ, get it.
And they're boasting the highest yield of this group at around 6.4%.
Okay.
As a major telecom provider, their services are pretty fundamental to a huge part of the population.
Yeah. Verizon runs a core business of providing essential wireless and internet services to a massive customer base.
Yeah.
And this generates a significant and relatively stable stream of cash flow from recurring customer bill payments.
Right.
People got to pay their phone bill.
Yeah, exactly.
Give you a sense of the scale.
Okay.
Last year, they generated $19.8 billion in free cash flow.
Okay.
And that's the cash that's left over after they've covered all their operating expenses and made their necessary capital investments in things like network infrastructure.
Okay.
And that $19.8 billion in free cash flow very comfortably covered
the
$11.2 billion they pay out to shareholders in dividends.
So generating significantly more cash than they're distributing as dividends.
Yeah.
Which I guess suggests a pretty healthy and sustainable dividend payment.
Yeah, it does.
What are their plans for future growth in such a competitive industry?
Well, they're making big ongoing investments
Okay.
in upgrading and expanding their next-generation 5G wireless network and their fiber optic network.
Okay.
And these investments are starting to show results in terms of growing their wireless revenue and overall earnings.
Right.
And now looking ahead, they've also got a pretty significant $20 billion deal in the works.
Wow.
To acquire certain assets from Frontier Communications,
Okay.
which would further expand their fiber network footprint and enhance their ability to provide high-speed internet services.
Right.
So these strategic growth initiatives should support continued increases in their dividend payments in the coming years.
And they already have a pretty solid history of dividend growth in the telecom sector.
Yeah, Verizon's increased its dividend payout for 18 consecutive years.
Wow.
Which is actually the longest unbroken streak of dividend increases among the major U.S. telecom companies.
18 years, that's really noteworthy.
It is.
Especially in a capital-intensive industry like telecom.
For sure.
Where they've got to make significant ongoing investments.
Right, absolutely.
So let's step back and look at all 5 of these companies together.
Okay.
Brookfield Renewable, Enbridge, NNN REIT, Rowe Price, and Verizon.
The Fab Five.
Yeah. What's the main thing you think we should take away from this discussion?
Well, I think the big takeaway is that all 5 of these companies, as highlighted in the Motley Fool article, are offering dividend yields that are, really attractive right now.
Yeah.
All above that 5% mark.
Yeah.
But what's maybe even more important is that they each have a proven history and seemingly solid future prospects for continuing to increase those dividend payouts to their shareholders.
That consistency is important.
It is. And that combo, of a significant current income stream and the potential for that income to grow steadily over time. It's what makes these companies so appealing, I think.
Yeah.
For investors who are focused on building, a lucrative and rising income from their investments.
It's also really interesting to see the variety of industries represented here.
It is.
I mean, we're looking at renewable energy, pipelines and utilities, real estate, asset management, telecommunications.
Yeah.
It really shows that you can find these high-yielding, dividend-growing opportunities across many different sectors of the economy.
Yeah, that's a key point. It's not just one narrow area of the market that's offering these kinds of yields and growth potential.
Right.
These are well-established companies operating in diverse sectors.
Yeah.
Many of which provide essential services or products that tend to generate relatively stable and predictable cash flows.
Right. And that's the fundamental fuel
That's right.
for consistent dividend payments and increases.
It is. It is.
Now, of course, we always have to remember that past performance is not a guarantee of future results.
Of course. Of course.
However, when you see consistent dividend growth over these periods that we've been talking about, 14 years, 30 years, 35 years, 39 years, 18 years, it does suggest a certain level of financial discipline
absolutely.
Within the company and a clear commitment
For sure.
from the management team to returning value to shareholders.
It does. That kind of long-term track record of dividend growth, it often reflects a healthy underlying business.
Right.
A prudent and disciplined approach to managing the company's finances. And a management team that makes returning capital to investors a priority in a consistent and growing manner.
Right.
There are always risks involved in any investment.
Of course.
But these long-term patterns of dividend growth can be a reassuring factor for investors who are specifically building a portfolio of dividend-paying stocks.
So as you're thinking about your own financial strategy and how you want to allocate your capital, really consider this. How might incorporating dividend-paying stocks, particularly those with a demonstrated history of not just paying but increasing those dividends, how might that fit into your overall financial plan?
It's a good question.
It's not just about the income you might receive in the immediate future, but the potential for that income stream to grow and compound over time, which can be a really powerful element of building long-term wealth.
Absolutely.
And it leads to a really important question for you to think about on your own. Beyond just that current dividend yield and the history of dividend growth, what other factors might be important for you to investigate and understand further when you're evaluating these types of investments?
That's a great question to ponder, for sure.